What we're going to do now, first presentation is about to start, which is Krissy. Now, Krissy is already live, so we've learned from our previous mistakes and haven't left it right to the end. So I was going to give you a little bit of an introduction on Krissy. And there you go, there's a picture of her, and she doesn't look any different whatsoever, having a bit more lippy in the photograph than she's got there. So, well, maybe it's just a different colour, I don't know. So, what you're looking for, delegates, is we sent you in the post these two items, and they've also been sent to you on email. So just grab hold of those. And that forms part of her presentation, obviously, but she's not just going to go through and talk to you about what the rates are and stuff like that. And what we also do now with every delegate is that we give you a little bit of history on them and also an interesting fact or an embarrassing moment. You can probably guess which one Krissy is going to be when I read it out. So Krissy is Senior Business Development Manager for InterBay Commercial, 15 years experience in financial services, working with brokers in the specialist and commercial mortgage market. Previously worked for One Savings Bank, trading brand Kent Reliance, and prior to that was with Shawbrook in their commercial team. Her interesting fact, which I rewrote Krissy yesterday, by the way, just to make it sound even worse than it actually is, just so you know. Krissy was having a photo taken with a broker at Essex Cricket Club and had to ask a guy for some space as he moved into shot just as the photo was being taken. The guy just happened to be Graham Gooch, one of England's finest ever batsmen, and he thought that Krissy wanted a photo of him and got closer, and she told him to op it. So it's actually not as embarrassing as my cricket story, which I'm never going to tell anybody, unfortunately, because I still cringe, and it was 20 years ago. So what I'm going to do now, just whilst I switch over the slides, I'm going to then pass you over to Krissy. So. Krissy, all yours.
Great, thanks Tony. Thanks for the introduction. It's just as embarrassing the second time round. But yes, thanks everybody for joining me today for the Specialist Web Show. Hopefully going to kick off and start things in the way they're going to carry on. It's going to be a great event, I'm sure. So as you know, I'm the Senior Business Development Manager for InterBay Commercial, having worked for Kent Reliance, Shawbrook, just to name a few. We're just going to start off looking at who are InterBay Commercial. So we are part of One Savings Bank Group, which includes InterBay Commercial, InterBay Asset Finance, Kent Reliance. Most recently, from October 2019, we combined with Precise and awarded Best Specialist Bank in the Bridging and Commercial Awards recently. So we're experts in adapting a flexible underwriting approach to your complicated deals, whether that's single buy-to-lets with complicated ownership structures, perhaps it's a multi-unit freehold block or a house of multiple occupancy, a semi-commercial property or a portfolio loan across multiple securities. Each case is reviewed on its own merits to help try and find a lending solution for you and your applicants. So let's have a look and see what we can do. I'm not going to read all of the bullet points out to you. You can read those for yourselves. Instead, I'd like to just focus on some areas that I've seen on my desk recently where I believe it would add some benefit to you as brokers. So I'm going to start off with the kind of client that we can lend to, the borrower, if you like. I heard a statistic recently that was, I can't verify it, I'm afraid, but it went along the lines of 70% of all new applications came in the form of a limited company. What I can say is the majority of inquiries I see across my desk do come in for a limited company. And what I like about InterBay Commercial is that limited company does not need to be a SPV, a special purchase vehicle. We're not going to check the SIC code. It could be that that company is a trading entity. So something that I see on quite a regular basis are development companies whereby they've retained those properties in the developing company and aren't looking to transfer that over into a specific holding company or an SPV. As you'd expect, we can lend to individuals, we can lend to partnerships, we can lend to SPVs, LLPs as well, but also uniquely we can lend to trusts, and we don't increase our minimum loan size when we're considering a trust application. We just need to be confident that that trust has got the power to borrow and we can take a personal guarantee. Something else that we see on a regular basis are day one refinance applications. So where somebody's looking to refinance typically within the first 6 months of ownership. We do want the land registry to be up to date, so do check that. But we see a lot of investors buying at auction, looking to do a bit of a refurb, and then looking at that term exit or that refinance onto a term loan where they're able to capital raise against the open market value, which is something that we can do as long as we can see where that value has been added. And talking about capital raise, we can actually capital raise for any legal purpose. So definitely something that's topical at the moment, where we've seen other lenders trying to go for more of a pound for pound refinance. You'll notice on the slides in front of you that we state a minimum and maximum loan size there. I just want to pick up on those 2 points. So whilst our minimum loan is 100,000, our minimum property value is actually 75,000. So when we're looking at those portfolios, if you've got a client that's invested perhaps up in the north or out into South Wales, it might be that you've got properties of 80, 90,000. That's absolutely fine. We can do a portfolio across multiple securities as long as we can achieve our minimum loan of 100. And that maximum loan of 1.5 is meant really just as a little bit of a buffer. If you were to just submit the case and off you go, we will consider loans over 1.5 million absolutely fine, but we want to do a little bit of extra underwriting and a little bit more upfront, as you would expect for a deal of that kind of size. So that was the kind of small buy-to standard properties, or what we consider standard. So in our, from an InterBay definition, that would be a single property, it would be a HMO up to 6 bedrooms, it would be a multi-unit freehold block up to 6 units. And for those properties, we can go up to 75% loan to value. When we move on to what we would consider a complex buy-to-let, so that would be your houses of multiple occupancy and multi-unit freehold blocks of between 7 and 20 units. We like the loan to value just to come down a little bit to 70%. But as I said, we can look at the larger HMOs. That could be a student property, it could be a property that's got working professionals in it or contractors, and those multi-unit freehold blocks are where you've got anything up to 20 flats still all on that one freehold title. Or potentially where we've got a broken block arrangement. So recently I had a developer that came to us whereby they'd developed a block of flats. It was 10 units. They had sold 2 off on a long leasehold scenario and repaid the development finance, absolutely fine. And we were looking to lend on the 8 that had been retained on the freehold, absolutely fine. As you would expect from a commercial lender, on these larger properties, we will undertake a commercial valuation. Something that's coming up really regularly that Tony just mentioned within his introduction are these bounce back loans and Sybil's loans. I get a lot of questions around how we would approach that and whether we would lend for clients that have got those for their businesses. And the answer is yes, we will, absolutely, but we won't accept them as a deposit. And to be honest with you, nothing's really changed on that front. We've never accepted a true independent third-party loan as a deposit, so very much business as usual on that front. What I would say as a top tip to you guys is if you've got a client that has perhaps bought on a bridge or they're looking to do a refinance within that first 6 months, we are likely to still want to identify the original source of deposit, even if we are just a refinance at that stage, so do just check back. Something else that I'm asked about a lot at the moment are payment holidays. Again, we don't have a standard blanket policy. As you'd expect with a manual underwrite, we do it on a case-by-case basis. But the kind of things we would be looking for, we're going to be checking bank statements for the clients. Have they been receiving rent, even though they've not been making their mortgage payments? If so, why? We're going to ask them the question, have you been financially impacted, so that they can put to us in their own words what that impact is. But most importantly, we're going to be checking a little bit more diligently their ability to cover voids going forward. So we want to see, does the client have any savings in the background? Have they got surplus monthly income which would cover our mortgage if that property were to remain unoccupied for a period of time? So let's have a look at semi-commercial. Again, the key here is that we will assess the affordability using that residential income only. So what that means to you is to achieve the minimum loan of 150,000, the residential element needs to be renting for at least £800 per month, 9,600 per annum. The maximum loan to value will go up to is 60%. And you'll notice that we're going to be doing a little bit more due diligence on the commercial element. So we're looking to see if it would be considered sustainable and viable in the current pandemic. Has it managed to trade throughout the duration? Was it that it just needed to alter its trading to perhaps more online from face-to-face? Was it able to diversify to takeaway as opposed to sitting in to eat? But what we do to help you guys is we do that assessment using our in-house real estate function. So we actually have a team of qualified surveyors within the head office function that will look at that as part of the agreement in principle with our underwriter, so that we can then provide you heads of terms, knowing that we're comfortable with the nature of that commercial tenant and where that property is situated. What we will then do for extra peace of mind is we're going to do a full pre-valuation underwrite. So prior to the client spending out any money on a valuation fee, that the bank's done as much as it can, checked everything that it can, and we are in a position to lend subject to that valuation coming back, which I think is a really, really positive in the current climate. As a lender that partners with brokers who tend to specialise in sectors of the market, we do see firsthand how investors change their strategy and how every situation can genuinely create opportunities. So that might be a change in regulation, it might be a change to tax, or it might be the current pandemic as we are now. At One Savings Bank, we genuinely believe that despite the current pandemic, the areas you can see in front of you now still represent growth areas in the market. And as a group, whilst we can't help with all of those, it's still worth acknowledging what those areas are. But there are several in there that we can help you and your client with. The area that I'm going to be talking about and focusing on specifically today is actually within the buy-to-let sector. And that's talking about houses of multiple occupancy and how we've seen investors move toward a more high-yielding model over perhaps historically where they've looked at capital growth. I'm sure you all remember changes to underwriting standards by the Prudential Regulation Authority back in 2017, which feels like a lifetime ago now. It really changed the way that the buy-to-let landscape shaped, and it changed how investors focused and move away from that capital growth, as I've just mentioned, more to a yield-based approach. Now, that could have been that they changed their area, it could have been that they changed their property type. But we did see a lot of investors move specifically into houses of multiple occupancy for the yield opportunity. So let's just recap on what a HMO is. The use of the term HMO at basic level simply refers to a building where unrelated people live together and have some sort of shared amenities like a kitchen or a bathroom. However, in England and Wales, the use of the term HMO has been incorporated within two separate areas of law, and that's planning under the Town and Country Planning Act of 1990 and licensing under the Housing Act of 2004. And we're going to come on to those. But let's just carry on looking at why HMOs specifically. So as a bank, we undertook a survey with a large percentage of our broker population. And from that survey, we identified that 51% of our broker population have been approached by landlords specifically looking to diversify. Now, this was undertaken in 2019. It's a little bit out of date, but still topical. And of that 51%, 56% of those inquiries were specifically relating to houses of multiple occupancy. Now, as mentioned previously, we had seen a shift toward yield over capital growth as a result of those PRA changes. Now, that could have been through changing their target area. We saw a lot of people diversify where they were looking to invest. We saw a lot of people buying cheaper properties, looking to refurbish and looking to add their own value, whether that was to then retain it for an income point of view or to flip it and sell it for the profit. We saw investors move more into the semi-commercial commercial space, whether that was for yield, whether that was for an opportunity to use permitted development and actually change parts of the property into residential. And we also saw a large percentage of investors move into houses of multiple occupancy, whether that was purchasing one that was already up and running or creating a newly converted one for themselves, ultimately to achieve multiple rental income from one property. I think HMOs used to conjure up major images of student lets, but we've seen a real shift. There is absolutely a student market for, you know, HMOs, but there is also very much a professional sharer market as well, or something that we quite often hear in the market called co-living, or it might be that it's industry related. We've got Hinkley Point not too far from where I am, where we see an awful lot of contractors needing accommodation, and as a result the HMO market has definitely picked up in that part of the world, driven purely by that nuclear power plant. As part of the research, we also had a look at, you know, what areas were investors looking at and why was that? So we could see that the highest yielding area at the point in time when we did this research was actually, you know, up in the northwest. And we could also see that rent was growing fastest over in the East Midlands. And what we saw as a result of that is that the really diligent landlord investors were seeking to combine a combination of high yielding areas, or where they saw those rents increasing, with the high yielding asset class as well. So I confirmed earlier in my presentation that the term HMO at a basic level simply refers to buildings where unrelated people live together and share some sort of amenity, and in England and Wales the term has been incorporated into two areas of law, planning and licensing. Unfortunately, these two areas are not connected, and compliance with planning does not mean that licensing requirements have been satisfied, and vice versa. Obtaining a HMO license does not mean that the property benefits from the planning permission. Licensing and planning requirements are generally administered at a local level by councils, but actually separate departments. So HMO licensing used to be properties where you had 3 stories, 5 or more people sharing in that property, where they came from 2 or more separate households and had a shared amenity. In 2018 October, we saw that the licensing law and definition changed. So they introduced a mandatory floor size, they removed the 3-story rule, and it applied to all HMOs, not just new HMOs. So even if you had one up and running at the moment, as soon as your license needed renewing, you would need to meet the new guidance to obtain your HMO license. That affected approximately 177,000 properties, and it meant that we did see circumstances whereby properties that had historically run as an 8-bedroom HMO, as an example, one of the rooms might therefore now be too small under the new guidance, and could only operate going forward as a 7-bedroom HMO. And you can see those room sizes in front of you. So 6.51 metres square for a single person, 10.2 metres for a couple, and 4.64 for a child. But it's worth bearing in mind that a child is only deemed a child up to the age of 11, and they then become an adult, requiring the adult room sizes. So let's not lose sight of why the licensing's there, and, you know, why some of these changes have been made. The desire to create a licensing system arose due to safety concerns connected with overcrowding. This is a genuine picture that you're looking at right now, which absolutely horrifies me. But it was connected with overcrowding in large privately rented accommodations. So it was introduced to ensure that landlords of HMOs are fit and proper people, or employ managers who are, and that each HMO is suitable for occupation by the number of people allowed under the licence. The standard of the management of the HMO is adequate, and that high-risk HMOs can be identified and targeted for improvement. The Town and Country Planning Act, so talking about planning, have then categorised use of properties into what they call use classes. So what you can see here are the 3 most common ones that we see for residential and HMO. So you've got C3 there for your residential houses, so where I'm sat today, my own home. C4 for your small HMOs up to 6 bedrooms, and then sui generis, which basically means a class of its own, but specifically for HMOs is for 7 bedrooms and over. I often get asked, and I'm sure you get asked this a lot, do I need planning permission to change my property to a HMO? Well, the general answer is yes. You'll always need planning permission to change a use of a property to a HMO, unless the general permitted development order allows permitted development. And in the case of a HMO, the following is considered PD, or permitted development. So typically you can move from C3, to C4, or C4 back to C3. But if the number of occupiers is to be 7 or more, then no such permitted development exists. Okay, that would be that sui generis. Each individual council has the right to remove permitted development by what is called an Article 4 direction. But many councils have passed such a direction, including popular student areas like Canterbury, Bristol, Bath, Bournemouth, to name just a few. And in these areas, you really need to check what the planning requirements are. So as a broker, I really do encourage you to ask your clients, where are you buying? Who are you going to be renting to? An Article 4 needs a mandatory licence, and often councils will want to restrict the number of HMOs in that area. So planning to convert to a HMO, it's not guaranteed. So they really do need to be on the forefront and check that up front. Now, different lenders genuinely have different policies and a different approach on HMOs. So, do check with your BDMs, check with your lenders, and try and think about your client as a lifelong customer, as opposed to just that one particular deal on your desk in that moment in time, because it really does help in the long run, understanding what their strategy is, what they're looking to try and achieve. When we look at HMOs specifically at One Savings Bank, we really do support clients into that market. We're quite happy to look at first-time landlords, first-time HMOs, up to 6 bedrooms. We value the property on a best rent approach. So even on those smaller ones, we will ask Connell specifically, what is the best rental approach on this property? Can you confirm if it's doing it via a room by room basis, or whether it would actually be more viable for your client to rent that as a single dwelling, because there's more demand as a family home as opposed to a HMO. On the larger ones, as I said to you earlier, we will go out on a commercial basis. So, we are viewing that very much as an investment and working off that yield approach. In summary, HMOs are becoming increasingly popular for landlords looking to diversify their portfolio. If it were easy, everybody would do it. HMOs can provide better yield and security. However, they do come with more stringent regulations and rules. InterBay are specialists in houses of multiple occupancy, and we genuinely can help ensure the smooth running of cases for you and your applicant. HMOs are advice rich, which always requires the help of a broker. Stay educated and keep in contact with specialist commercial finance. Thank you. That's me done, Tony. Any questions?
Yeah, I'm just waiting to just go through the last one. So has anyone got any questions they'd like to ask Krissy regarding InterBay or products or any sort of criteria bits and pieces? It looks like Melvin's typing, so we'll just wait for Melvin's to come through. Or I could ask you, we do have some sort of pre-written questions. What I've also decided to do from this week is to just chuck in a couple of questions that the speakers don't know about to see how they get on. So you can see the bead of sweat now dripping down her forehead. So first question I've got, oh, there you go. Melvin said, do you do serviced accommodation?
We tend to find most serviced accommodation inquiries that we get Melvin involved much shorter let terms. So unfortunately, that's not something that we would be considering at the moment. We have historically been able to view them under commercial terms, but we're paused on our commercial lending at the moment, only able to look at buy-to-let and semi-commercial. So it might be when we return to commercial terms that if the client's operated it for long enough, we might be able to view that on its own merits. But right now, today, I'm afraid the answer would be no.
Okay, I have no, there was one coming through, not come through as yet. My landlord has an HMO with a license in place, but there's no planning. Are the license and planning application not one and the same?
Thank you, Tony. Hopefully you picked up in my presentation today that licensing and planning are absolutely not one in the same, and the two departments of the local authority do not talk to each other. So do make sure that you've done your due diligence and check both the licensing and the planning of the property. And then if you've got any concerns, obviously up with Tony and the team at Specialist or myself.
Okay, Rakesh has asked, how do you assess portfolio in the background?
Great question, Rakesh. We assess the background portfolio using a stress of 125 at 5%. We're going to average out the debt and the value. So we're just looking at collectively. So all of the values, all of the loans attached. We don't insist that it's under 75% loan to value. So if you've got something that's highly geared, I don't know, there might be a legacy mortgage express portfolio knocking about. That's absolutely fine as long as it still meets that 125 at 5.
Okay, right, we've got that one. Another question. I have a landlord with a large student accommodation, which is a 6-bed HMO, but there's also 2 self-contained flats as well. It's all on one freehold. Can you do this?
Absolutely. Again, that's a pretty common occurrence at InterBay. We'll see a real mixture of assets. That could be a collection of studios. It could be a mixture of a HMO with some self-contained flats attached. All of those are absolutely fine. And the beauty of having commercial valuation is we're allowing the value to go out and assess that and look at the rent. And then obviously we'll just check the planning situation for that property. But short answer, yes, we can consider that, no problem.
Fantastic. Possibly one more, maybe 2. There's nothing from these speakers, and there's not. When will you consider commercial again?
Yeah, I keep getting asked this one, and I wish I had the definitive answer for you. I do want to reassure everybody that's listening today that we're absolutely committed to the commercial space, and we will return when it is the right time to do so. But I'm afraid at this moment in time, Tony, I don't have the date for you. But as soon as I hear, you will know firsthand, I promise.
Fabulous. Right. Okay. Well, Krissy, thank you very much. I don't think there's any more questions.
Thank
not.
you.
So, Krissy, thank you very much. Brilliant as always.
Thank you.
We'll speak to you again soon.
Bye.
We now welcome James Briggs from Precise. It's like seamless today. This is blimey. I'm just going to put on James's presentation, or James's introduction first of all, which doesn't have an embarrassing fact. It's more of an escape more than anything else, which we'll come on to in a moment. So as you can see, there's James. He's a little bit brighter in that picture than he is actually in the room that he's in. So he does, yeah, there he is. You can see his face. That's good. Okay, so a little bit on, first of all, Precise, but delegates, if you could, I found my clicker, by the way, which I lost about 2 weeks ago. I just found it in the bottom of a bag, so I'm going to use that rather than the mouse, so it's not as noisy. So delegates, you're looking for this second charge loan products, and that's a double-sided document. So on to James. Known James a long, long time, one of the nicest guys in the market, always good company. We do like dealing with people that enjoy what they do, and James is certainly one of those. We think he is. I don't know. After 6 months of lockdown, he might hate it by now, but he's one of those people. He's always got a smile. He's just really, really good company. So, and a pleasure to do business with. So James has been around quite some time, as you can see, well over 20 years, in a variety of different roles. Joined Precise in 2013 to build and launch their second charge proposition, and now spends the majority of his time helping to grow awareness of the benefits of second charges to intermediaries, managing relationships with key distributors, and developing the Precise Mortgages second charge proposition. Interesting escape, we call it. As a child, James wrote off and was accepted to appear on Jim Will Fix It. Fortunately, he was on a family holiday for the scheduled recording, so he had a lucky escape. So there you go. What you can say about that, is there really, I suppose? Right, okay, just whilst I switch over onto James's slide, which will be just a couple of seconds. And we had real problems with James's slides the last time because his marketing department had actually designed them in reverse. So you had to click a button. Unfortunately, this click meeting software doesn't work with PowerPoint on sort of like animated presentations. So you get the whole screen up at one time. Well, Precise had actually designed theirs so that everything disappeared when you clicked on it. So James, it's over to you, and I'll see you in about 20 minutes.
Thank you very much, Tony. Morning, everyone. Thanks for joining. I'm going to talk to you today for about 20 minutes or so on some of the opportunities in specialist lending, specifically for residential clients. So we're not going to talk through the product guide that Tony sent you in the post, but you'll see on there the terms are a bit more restricted than what you would normally see in the seconds market. So like a lot of lenders, we're taking stock of the impact of COVID at the moment, for example, the effect on unemployment. So it's more restricted than usual and what I'd like personally. However, we're expecting some normality to return to those products over the coming weeks and months and when the furlough scheme ends. So we'll kick things off, as I tend to do in my presentations, by quoting a famous person, and this time it's Winston Churchill. So he once said, "A pessimist sees the difficulty in every opportunity, an optimist sees the opportunity in every difficulty." So I've had that quote in my presentation for about the last 12 months. I think it's more pertinent now than it ever has been before. So no doubt as advisors and business people, over the last few months, you've been targeting some different products and markets. For example, a lot of my contacts in the mortgage world have been focusing a lot on product transfers and protection, which is great. So hopefully today, my presentation and the other presentations you'll see will give you some food for thought on how to introduce even more diversity and income opportunities into your businesses. Okay, so what's 2020 shown us so far? Well, it's been a challenging year, it's fair to say, for brokers and lenders alike. It caused a huge shock to the lending markets, which affected almost all clients and lenders, and we saw a severe drop in lending across the board. However, as the weeks and months rolled by, some confidence started to return, which was good, helped along by some government initiatives, particularly stamp duty on purchases to get people moving and fire the property market into life. So it's fair to say that the high street's probably recovered faster than the specialist lending market, but clients that are going to the high street are experiencing some what I would call cherry picking at the moment. So whilst the high street has 90% LTV products, it's a very limited opportunity to achieve those products, very high credit scoring. Some restrictions around loan purposes happening now that weren't happening so much before. And in particular, one big impact is lenders on the high street are restricting or even removing altogether the use of overtime, commission and bonus. So in essence, the stricter the high street gets and continues to be, the more clients can find a home with a specialist lender or even a specialist product. Okay. Next slide is a really good example of how the market's changed. So click on the next slide, there we go. So this slide demonstrates the rise in the amount of people that have been self-employed in the economy over the last 20 years. So we've seen a huge increase from 3.3 million in 2001 to just under 5 million people in 2019. And there's every possibility that that trend will continue as another byproduct of COVID. So some of the things that we're doing at Precise Mortgages on our second and mortgage side to help self-employed clients is we'll look at using the latest year's figure, if that's higher than the previous year. We'll consider using an average of their last 2 years' figures if the income's decreasing. And I think that will particularly come to the fore next year when self-employed people have experienced this period of drop in earnings. And we'll also do loans for business use and business expansion, whereas those options could be restricted through high street banks and relationships that self-employed clients have with their business managers. Okay, so moving on to some of the opportunities around seconds, but before we get there, let me give you a very quick history lesson. So in 2016, the European Mortgage Credit Directive, or MCD, was implemented. This was a real game changer for the second charge market for the reasons on the screen. So any broker that was acting in the spirit of the regulation would have to consider a second charge option for any client looking to capital raise rather than just automatically remortgage them. Any broker or firm that used the word independent in their title had to consider seconds alongside traditional remortgaging options. Fees became more aligned to the first charge market and when clients could pay fees. So historically, clients could not pay any fees up front, which led to very high fees on the back end being added to customers' loans. Customers and brokers have now got the option of how those fees are paid. And there's a general huge increase in the transparency of second charge cases now. So hopefully all or most of you have at least presented the client with a second charge quote at some point since 2016. If you have, you'll be aware that you get a mortgage illustration, which looks identical to the mortgage illustration you would get on a remortgage or a purchase. So it's very clear for the clients to compare the two different options and the cost, total amount repayable, rate, and everything. So far more transparent now than they've ever been in the past. And since 2016 and these changes, we've seen far greater broker engagement, which is great. More bank-funded lenders have entered the market. So healthy competition's grown, and competition leads to better products for clients and more solutions as well. So it's been good all round. So if we move specifically to seconds and some of the features of the products and opportunities over the next couple of slides, why should you look at seconds? So a couple of misconceptions here. So the term of a second can be shorter or longer than the remaining term on the client's existing mortgage. So you might have a client with only 1 or 2 years left on their existing mortgage. They don't want to touch that, but they want to capital raise for another reason. We would be fine doing a 10, 15, 20-year loan behind a mortgage that's only got 12, 18 months remaining on it. The amount that the clients can borrow can be greater than what's outstanding on their first charge, or it can be shorter, smaller. It's usually smaller than what they owe on the mortgage, but in some certain circumstances where the clients want to keep the existing first charge in place, they can borrow more. There's a couple of examples of that on the next slide. Two real strong USPs of seconds is around tie-ins. So on all of our second charge products, we have no early repayment charges. So it's very easy for clients to come in and go out of these products without any penalties, which is great. Where that's a real advantage is for clients that want to make overpayments. So we do not charge any penalties for clients that want to make overpayments. If they choose to make those overpayments, we can either reduce the term remaining on the second, or we can recalculate the monthly payment for the client. So super, super flexible. You get a lot of clients who want to drive down the contractual monthly payment as low as possible, but they might get quarterly or annual bonuses and they want to chip away at the capital by paying overpayments. They're totally free to do that without any penalty. Some real strong selling features of seconds on that slide. Probably the most important slide of all is opportunity spotting. So there won't be many clients that walk into your office, unfortunately, who declare, I need a second charge loan. So it's really important to have an understanding of the classic opportunities where you could consider maybe engaging with a second charge lender, or hopefully talking to Tony and getting a comparison of the whole market on what's available. So these are the main reasons. So you will have clients who are tied into their existing first charge product with ERCs, and there's no further advance available. Okay, that is more and more common now, because as a mortgage community, for the first time ever, more than 50% of new mortgage originations are on 5-year fixes or longer. So great, clients are locking into really inexpensive 5-year products. They're getting some medium-term stability. It's great. However, what happens if 2 years into that 5-year fix, they need to do some debt consolidation, or they want to do some home improvements and they can't get a further advance from their existing lender? Okay, so what the regulator wants is brokers to weigh up the option of the remortgage, taking into account the hit on the early repayment charge versus doing a second charge loan for the client now. And if you do that second to service the client's requirement now, it gives you the opportunity to review their overall circumstances when they come to the end of the tie-in period on the 5-year fix. So really you could get 2 bites of the cherry while still giving them the best advice at that point in time. Okay. Seconds can be used to protect an existing product. So there's a lot of clients out there with a very low legacy tracker products that they just don't want to move away from. Get a lot of clients who've got historic interest-only residential mortgages. So if they go back to their lender requesting a further advance, their lender might go, yeah, that's fine, no problem. We can give you that extra 30,000 for home improvements. but all of the debt needs to go on to repayment. And that might not work for the client in terms of their financial plans, or it might not work from an affordability point of view. So it's a good way of protecting their existing mortgage product. Then we have non-standard purposes, which we'll come on to on the final slide, and income multiple restrictions. So as Tony said, I've been talking to brokers for many years about second charges. Historically, I'm not going to hide behind the fact that seconds came from the subprime world to begin with, but the market is totally different today, especially with all these bank-funded competitive products in the market. So a lot of prime clients who you would call a high street client all day long, no adverse, good income, good stability, but they need to borrow to 5 or 6 times income that's not available on the high street. Okay, seconds are a perfect way of topping up their borrowings for any purpose. So on all of our products, you can go to 6 times income multiples, and that's fairly common across the whole second charge market. It's a great way of servicing those status clients, but who need to borrow at higher income multiples. Okay, then you have speed. Okay, so it's not uncommon for a second charge to move from initial inquiry through to offer and completion in less than 10 days. One of the beauties of seconds is there's no solicitors involved in the chain. Okay, so between us and the packager, we do the work that a solicitor would do in terms of checking the title, checking the register, the charges, the lease length, getting consent from the existing mortgage lender. That is all done by the packager and all checked by the lender. So there's no solicitor involved in the chain, which is great for 2 reasons. So speed, you can get the things through a lot more quickly, but also the clients aren't picking up any conveyancing costs as well. So it's the dual benefit of that. Okay, then we have a couple of slides on the UK debt statistics. I'm not one to dwell on debt statistics. It's not great news. This position was worsening a little bit even before COVID. So with the compression of household income, we're starting to see on credit reports now and some kind of macro reporting that our business does, credit card balances increasing on average. So these clients will undoubtedly need some help in the short and medium term, maybe over the next 3 months, 6 months, 3 years. Offering seconds could be the right solution for them. So please do bear them in mind when you get those clients coming to you who are starting to get it a little bit in above their heads and need some help and advice. Okay, one of the historic drivers for credit card debt historically was self-employed people using their credit card to pay self-assessment tax returns. Now, Inland Revenue have stopped accepting credit card payments now. So a second charge loan is an acceptable purpose for us, for the clients to clear their tax bill. Now, we do a bit of due diligence because what we don't want is the client coming back to us each year for a further advance to pay their tax bill each year. But there could be a set of circumstances, which means in this particular financial year, the clients are struggling. Okay, and I'm sure we will see that in January to April 2021, where self-employed clients have had a lean year for obvious reasons. So we can help those clients as well. So they could do some business use, some business investment for expansion, and also take care of their outstanding credit card or tax bill at the same time. Okay, so final slide before questions, just some of the different purposes that second charges can be used for. You will hear a lot of BDMs saying any purpose, any use, which is great, but I like to drill down into some of the specifics and some examples that we've used seconds for. So home improvements is a classic and obvious reason for seconds. That can be anything from a new kitchen, decoration, carpets, right through to structural work, extensions, even if the clients need to move out of the property while work's being done for a short period of time. We've also had done seconds for clients who've been midway through extending a property. They've moved out and they've run out of money, or they've gone for a higher spec kitchen, granite work surfaces instead of IKEA work surfaces. That's fine, as long as we know the property is wind and watertight and the clients are going to be moving back within the next 3 months. Okay, so we can use seconds for that purpose. Then we have property investments. So no doubt we've got some non-regulated brokers in there, or you've got clients within your client bank that are property investors. You might have clients that are equity rich and cash poor and want to continue investing in property and buying property. They can use a second charge on their main residence as a way of doing that. So you could take money out of the main residence to fund a deposit on a buy-to-let and use a first charge buy-to-let mortgage in conjunction with that to achieve 100% funding of a new buy-to-let purchase. You might have clients who speculatively want to draw funds out of their property by way of a second charge, but they haven't got a target property that they want to invest in at this moment in time. That's fine with us. If they've not found the property they want to invest in, they can pull the money out, sit on it until they find that right investment. And then we've got other stuff like bank and mum and dad lending. So people who want to get their back bedroom back, they can help their kids onto the property ladder using a second charge as an investment, as an investment tool for them. Then we have business purposes. So clients who want to invest in existing businesses. So we've had everything from car dealers wanting to buy stock en masse through to office refurbs, IT systems, vehicle fleets. We don't drill down into the specifics of what they're using the loans for. So we wouldn't be looking for any business plans or invoices. All of the money on our second charges is released to the clients, with the exception of any existing charges that we're clearing or tax bills. Everything else, we send the funds to the client. Then we have land, things like land purchases. So I've got a lot of clients in rural areas wanting to buy land adjacent to them or opposite them to stop developers from acquiring the property. School fees is an interesting one. So what a lot of the public schools do now is they're offering parents the opportunity of paying for 3 or 5 years schooling up front and giving them a heavy discount. So we've had clients taking £250,000 second charges, granted high net worth clients, to pay for school fees up front, which when compared with paying on a term to term basis has saved them 50 grand in school fees. So it's just a different way of kind of funding those costs. Tax bills that we've talked about, debt console, which is the classic purpose for seconds and where seconds arose from 30 years ago. I wasn't in the business then, but Tony was. And then holiday homes. So we'll fund those here or abroad, no problem. We don't need to see where they're buying. As long as we know it's for a holiday home, we'll release all the cash to the client and then they can go off and take care of the purchasing of that themselves. Okay, so I am not Dan Watson.
No, you're not.
Get rid of that. No, far better looking than him. That concludes the presentation. Hopefully that was useful and gives you a little bit of food for thought on the different uses for seconds. And we'll hand things over for questions now.
Okay, nothing at the moment, James. We do have, I think it was Rakesh was typing something, but it hasn't appeared as yet. So we've got some pre-prepared questions as usual. Are there any lenders that do not allow second charges to be registered behind them?
There are a couple of lenders. They tend to be the more niche lenders, so non-council mortgage lenders. Companies you might be familiar with that don't allow seconds. The main ones are Principality. They're a little bit difficult with seconds. Mortgage Express on the buy-to-let side, they're a little bit in book reduction mode. And there are some accounts with certain lenders. Santander had a historic flexible account. There's not many of those left now. That don't allow seconds because it's like a revolving credit facility where the clients can keep on taking further advances out up to a pre-agreed limit. There aren't many, but I suppose that's one of the benefits of using a business like yours, Tony, is you guys will be well versed. You probably know better than I do the lenders that won't accept seconds, so you can rule those out.
There tends to be, if it's a regulated deal, you tend to find that with lenders being petrified of the FCA, they quite often will grant consent, even though their terms and conditions might have said many years ago they will not grant consent.
Yeah.
So your odd product, maybe sometimes Bank of Scotland products, some old legacy products, Santander product that they haven't done for about 15 years is difficult to get consent behind. But in the main, it's not as much of a problem as it used to be. We used to have problems in that what lenders would do was to refuse consent and then contact the client directly and offer them the money themselves as a favour advance. So that was always a problem. That doesn't tend to happen anymore either. So it's more of an issue mainly on the buy-to-let side of things, where you do have the likes of Mortgage Express and a few others. But we do now have lenders that do not require consent to be granted because they won't take a full charge or take an equitable charge over the property. So that's beginning to come back. We've had 2 questions from Rakesh. So I think I've just answered the second one. I think I've not read it in full.
Yes.
Rakesh has asked. So I've just got a load of my emails are popping up in my bottom right corner where where all the questions are. So Rakesh has asked, what is the maximum loan to value on a second charge buy-to-let, capital raised towards deposit onwards resi purchase, 3 buy-to-let in the portfolio living? James, I'll probably answer that one because I know you haven't come back into buy-to-lets yet. Rakesh, we currently have, I believe we have a product now 85%. It's not the cheapest out there. We do have some very decent products at 75%. So depending on what loan to value they need, there are now products. I mean, 4 weeks ago, I think we had 1 lender in the second charge buy-to-let market. I think we're now up to 4 again. So it is gradually coming back. Precise were in that previously. Hopefully they'll be coming back soon. I mean, Precise, I think for James to actually present today, because their terms aren't great at the moment because it's still very restricted. But we know they're going to be coming back, and they could be coming back literally at any time. So across the board at the moment, with what we call our prime lenders, we've just had Shawbrook have just increased up to 85%. So that's now 3 lenders, I believe, at the prime end of the market, where we class Precise at. They're back up to 85%. And just products are just coming back every single week, or sometimes it's every other day. We're seeing a relaxation in what the lenders are offering. So if it doesn't fit with Precise, then it would more likely fit elsewhere. And Rakesh is banging in the questions. Thank you, Rakesh. Any issue with TMW Nationwide obtaining second charge? Nationwide, no. They need a deed of priority to be signed. They've never refused consent from my knowledge. TMW are a pain, but they won't refuse consent on their old legacy residential products. Only anything over 60% LTV on a buy-to-let. But as I mentioned, we now have lenders that will take an equitable charge. So TMW don't know anything about it. So Rakesh also asked, what is the maximum loan amount? With Precise, it is
200,000 currently. Was 500,000 previously, and we will get back up to that level.
Okay. You probably find, Rakesh, that at the moment, it's one of those situations where lenders quote, I mean, for example, Precise are quoting 200 grand. I'm sure if I went to James and said, James, we've got this fantastic deal, 25% LTV, and the client needs 250, he'll try and find a way of doing it. If not, then we've got others that definitely will do it. The largest second charge we've ever done was 1.25 million. We managed to get through in 8 days. And the client was so happy with what happened because he'd been turned down. The guy was earning £300,000 a month. He was an international lawyer looking to complete on the purchase of a property in the south of France, and he needed 1.25 million in 10 days. We did it in 8. And the only client I've ever had who's actually said to me at the end of it, I want to increase the amount of fee that you're charging me. And he did. He sent us another 5 grand. This was pre 2016, by the way. So we was allowed to do that then. So it's the only client I've ever had who's actually increased how much they wanted to pay me. Unfortunately, he didn't do it in cash. He did it by bank transfer. I just had another couple of things. In fact, I've got any more. There's no more questions from the delegates. Why is the second charge market still relatively small in comparison to the remortgage market? In your view, I've got a view on this as well, but what's your view?
My view is twofold on that. So I think seconds are competing with firsts at a time of record low interest rates on firsts. So record low margins for lenders in such a competitive world, but coupled with a super low base rate. And when I say a super low base rate, I'm not talking about 0.1% as it is now. I'm talking about 0.5% or 0.75%. So it's very cheap money out there for clients at the moment. So that's part of it. But I think the other part of it is that a lot of brokers still haven't embraced seconds. They still think of Seconds as that that subprime product from the 80s and 90s that they can't or won't even present to their prime clients, and that is that's not an accurate representation of what the seconds market looks like today. The seconds market is a prime market. If you look at 90% plus of the deals that are written, certainly for us, those are clients that could have remortgaged with the high street. It's just for at this moment in time for them, because of tie-ins or whatever reason, a second charge is the best option for them. So it's twofold. It's rates, but also maybe still underappreciated by certain quarters of the broker community. But that is definitely changing, and we're getting more engagement year on year.
It is, and back in 2007, the second charge market was worth about 6 billion a year. At its peak prior COVID, I think it was at 1.1 million. Probably one very good reason for that. If you remember, but way back to 2006, 2007, you couldn't, if you put on Sky TV, any channel you went on, there would be a second charge advert in the middle of a program. We started seeing adverts in the middle of like GMTV, in the middle of Loose Women. Some of the bigger advertisers, those you might remember, Ocean Finance had their own TV channel. The awareness that was around at that time on second charges for the general public was enormous. That's one thing that hasn't returned. There hasn't been one broker out there who's really grabbed the bull by the horns on second charges and gone for it like big time. It just hasn't happened. But if you think back in 2011, 2012, we had a market worth over 1 billion. That was the payday lending market. And that was because market awareness, like public awareness of a product that was being advertised literally everywhere. Radio, TV, literally everywhere. So it'd be nice to see it come back. I think the market still has a lot to do. The sourcing systems that are out there, which I'm going to talk about a little bit later, are not fit for purpose, and that doesn't help. There still is a legacy, like James has mentioned, on second charges that I still have brokers speak to me sometimes and say, what are the redemption penalties? Are you still charging Rule of 78, which I think was outlawed in 2008, which was a horrible calculation. It was a Consumer Credit Act that you could end up taking a loan over 25 years and 15 years later, you still owe more than you actually borrowed. Sourcing systems for me is one major problem at the moment. The brokers aren't using them because the sourcing systems have just decided to time with one broker, which I think is a real shame, because when you've got rates, I mean, our cheapest published rate at the moment is 3.37% per annum for a second charge. We've got one lender who doesn't have a rate card, so we have to run the deal through their system first of all. The cheapest we've ever done with them is 2.9%. The cheapest they've ever done for any broker is 2.11%. That's for a second charge. And when you think, when I came into the market, it's 37 years. On the 20th of September, I set up my first brokerage in May '89. When I set up that brokerage, we had two rates on offer, which was 22.6 to 90% LTV and 25.6 to 95% LTV. And then a lender came out with a 29.7 rate at 100% LTV. And that is literally all we had through every lender we dealt with, because no one was out there wanted to rock the boat. And then all of a sudden, one lender came out one day with a 19.7 rate, which was a 90% product, but for cleaner clients, almost 20% interest rate. Absolutely horrendous. And compared to now, the market was probably bigger then than it is now, unfortunately, with those rates. So it's something really that probably mortgage brokers need to sort of, if you haven't got a knowledge of it, that's what we're here for. We're here to help you. We're here to help training, here to help you source whatever you need to do. So, okay, we haven't got any more questions. I haven't got any more. Can
I just say one more thing, Tony?
You can, absolutely.
Thank you. Money Supermarket are currently getting 1,500 inquiries a day for second charge loans. Okay, so the vast majority of those clients would have used a broker at some point in the past. It's just that brokers maybe lost touch with the clients, or the client views their broker as a mortgage broker only. So I think it's really important that mortgage brokers kind of communicate the different options to clients that are in the client bank. And you as a broker, I guess, you know, I've never been a broker, but if I were to be a broker, my client bank would be my lifeblood. And I would want to guard that with everything. And one of my pals is actually a senior marketing exec for Money Supermarket. And he tells me that they have a product density target of 7. So when a client goes onto their mailing list, they will aim to sell them 7 different products. Okay, so they're going to be going after life, critical illness, home insurance, pet insurance, travel insurance. Okay, there will be brokers whose clients today are applying on Money Supermarket for second charges because they don't know their broker can help them with that. And then they're going to chip away at those different products and try and sell those clients lots of different products, which will affect those brokers' trail income as the months go by. So it's really important. Final thing I want to say is for everyone listening, Tony runs a great business. Please do use him. I've worked with Tony for over 12 years now. They treat customers really well. And from a lender's perspective, they package the cases really, really well. Okay. And that can be the difference between a 10-day completion and a 30-day completion. So pick your packager wisely. And I would definitely recommend Tony's firm. So thank you for listening.
Absolutely. Thank you, James. Your brown envelope's in the post. There's nothing in it, by the way. So, because I can't.
I mean that.
No bribes for benefit of the tape. Okay, James, thank you very much. Very informative as always. Right, delegates, what we're going to do is we're 2 minutes ahead of schedule. So we're going to take a short break, probably get back if we get back about 25 past 11, that would be great, just in case any of the last 2 speakers run on a little bit. So do whatever you need to do, mix up the coffee, use a loo, whatever you need to do. We'll see you at 25 past. On to our third speaker. Hopefully you've all refreshed and ready for the next session. So just on to our third speaker. It's Josh Knight from Octane Capital. You should, delegates, be looking for this within your the pack we sent you, an email that I sent you this morning, which is the Octane Buy-to-Let Product Guide, which is on A3 paper if you've received it in the post. And this, by the way, everyone, is a great product. That really is a great product. So because it's doing stuff that nobody else is doing at the moment. So please give it a good listen. Just on to Josh, a little bit about Josh first of all, and then his interesting fact, which always gets a round of applause, by the way. If any of you want to give a round of applause, just put clap, clap, clap in the thing. So Josh joined Octane February 2018 from Mariana Capital, where he was head of sales. He's over 10 years experience of managing intermediate relationships across private equity and property finance during his time at GMAC RFC, Octopus Investments, Mariana Capital, and now Octane. He has a passion for property finance. Having been exposed to startup packager and lending businesses from a young age, he enjoys the challenges the specialist property market presents and likes to work on difficult scenarios. Okay, his interesting fact, which is incredibly impressive, in May 2020, Josh completed 5 marathons in 7 days and raised over $4.5 grand for NHS charities together to support NHS workers and volunteers on the front line of the coronavirus pandemic. So Josh, as I always say, I think it's the 3rd or 4th one of these that you've done since the start of July. Very well done on that. I mean, I'm still haven't got to my couch to 5K yet. I've not actually got off the couch yet, so which I've been planning to do now for about 3 months. So it says a lot if you can do 5 of those in 7 days. I could even walk a mile at the moment, I don't think. So there you go. I'm going to put it over to you. And if you just bear me 1 second, I'll get your slide up. I'll also turn my mic off so we don't get the feedback.
Thank you, Tony. Right, so I'm having a few technical issues. So can everyone hear me? You just drop maybe a yes or a no in the comments, just so I know that you can hear me. Good stuff. All right, perfect. So hi everyone, my name's Josh. As Tony said, I'm a BDM at Octane Capital. I've been working with Tony and the guys for 3 years now. And we really appreciate the opportunity to talk to you all today. First of all, a little bit about Octane before we go into the main part of the presentation. So Octane are a specialist lender. I suppose we're a bit different to most buy-to-let lenders in that we're really mainly a short-term lender, bridging, refurb, developer exit, but we also do buy-to-let. The good thing is that we apply our same mindset as we do to short-term lending as we do to buy-to-let, and also the speed. We underwrite buy-to-let cases as quickly as we do bridging cases. We've been lending for just over 3 years. We were set up by 3 individuals who are behind one of the largest bridging lenders in the UK. Together, they had lent £3 billion before even launching Octane. Together at Octane, we've launched nearly £1 billion in the 3 years we've been lending, and we've won a few awards along the way. This year, actually, we won Bridging Lender of the Year at the B&C Awards and the Money Facts Awards, as we did the year before. But this is all about buy-to-let. As I mentioned before, we do other stuff, bridging, developer exits and refurbs. If you have other cases you'd like to talk to Tony and the guys about, please do. But today, as I say, is about buy-to-let. There are 2 things that make Octane different to other buy-to-let lenders. And these are the 2 things to kind of bear in your mind throughout this presentation. The first is we don't stress test. The way that our interest rate works is that we start at a certain level, we defer a portion of the interest rate and make it payable at the end of the term. And then your pay rate, we only need 100% rental cover at that pay rate. And the product of doing things in that way is that it allows us to look at cases where the borrower has a limited deposit, because we can often lend a lot more than other lenders because we don't stress test. But it also allows us to look at low yielding properties. So we do quite a lot of new build blocks in London, for example, that where the yield is low, and often other lenders can't lend as much as us because of their stress test requirement. So we don't stress test in any cases, only 100% rental cover is needed. The second thing is we aren't a mainstream lender, so we don't operate like one. And that means that we can look at difficult cases, both in terms of the borrower, but also in terms of the property. So the types of borrowers we can deal with, and we'll come on to this later, but foreign nationals, adverse credit, first-time buyers, first-time landlords, even offshore companies and trusts we can look at. And also difficult properties, semi-commercial, residential above commercial, short leases, large HMOs, multi-unit freehold blocks, ex-council. You know, there's almost no property type that we won't lend on. So hopefully that adds another string to your bow. So before we go on to the actual products themselves, this is just a kind of overview of our criteria. We only lend in England and Wales. Our minimum loan is 150,000, and the maximum loan for buy-to-let is 5 million. I can't say we do a huge number of cases at that level. I'd say average case size for us is probably between 300,000 and 600,000. Our starting rate, the lowest rate we offer, is 4.99% per annum. 1% of that interest rate is deferred and is payable at the end of the term. And that means that your monthly payment is based on a 3.99% per year rate. And then 1% per year is added to the loan. The best way of looking at it is, if we're at 70% loan to value and it's a 5-year term, your redemption figure will be 75% at the end of the term, because 5 lots of the 1% deferred are added to the loan. Now, crucially, we don't stress test, and you will get bored of hearing me say that, I promise you. But it is the key selling point of the product. We only need 100% rental cover. So in the case of our lowest rate, 3.99%, 100% at 399 is the rental cover requirement. And that really allows us to lend, you know, a lot more than other lenders. We do 5, 2 or 3 year terms, and I'll come on to that in a minute. We never charge an ERC in the final 3 months of the term. So that always gives you the ability to exit without fee. We pay a 2% proc fee to Tony or his team for cases introduced to us. And as I mentioned, difficult borrowers, difficult properties can be catered for. So this is our rate card. Now, I'm not going to go through this in loads of detail because it would bore the life out of you. And I'm not going to go through criteria in lots of detail, but hopefully you have been sent our product guide. The product guide lays out the different scenarios, the different rates, and it should give you a lot of detail. The idea really here is that we offer 5 different products: wave 1, 2, 3, 4, and 5. each product, as you go up the scale, has a higher rate. And the idea is that we try to cater for really complicated cases. So as you go up the scale, the more complicated the case can be. For example, if it's an HMO, the number of rooms that are permissible increases as you go up the scale. If it's adverse credit, down the bottom end, the credit has to be quite clean, but at the top end, it can be significantly impaired. So that's the idea. Somewhere within that range, we can cater for all scenarios. Let's start at wave one. Wave one is our cheapest rate. The case is over 500,000. The rate is 499 with 1% deferred, giving a pay rate of 3.99%. If the case is below 500,000, the rate is 5.49, 4.49, and that large loan rate decrease you'll see throughout the scale. Wave one is a 5-year term. We only need 100% rental cover at the pay rate, as is the case for all of our products. And the ERC staggers downwards, 4%, 3%, 3%, 2%, 1% in years 1, 2, 3, 4, and 5. And there is no fee in the final 3 months of the term. Wave 2 and Wave 3 work in the same way in terms of structure. So they both have a 5-year term. The ERC stagger downwards, and there's no ERC in the final 3 months. But you'll see that the rates are slightly higher. So they start at 549, 449, they go up to 599, 499, and so on. Wave 4 and Wave 5 are slightly different in that they have a 2 or a 3-year term, and that there is 2% deferred by way of interest. So for example, Wave 4 has a 699 rate with 2% deferred, giving a 499 pay rate, and the ERCs work in a slightly different way. But please do read your product guide, because that has everything that you'll need in it. So when you have a case, you'll be able to look down the criteria and work out which product your client can have access to. One thing worth noting at this point is that these products aren't available to the whole of the market. Waves 1, 2, and 3, you can only access if you go through a specialist approved brokerage, of which Specialist Financial Services are one. So if you want access to those cheaper rates, you need to speak to Tony or one of his team. So this is the most important point of today, because criteria is really, really boring, although you have the product guide for that. This is a slide that helps you think about the types of cases that we can help with. So on the left, you've got the borrower profile, and on the right, you have property type. So first of all, borrower profile. What borrowers should you think of Octane for? Well, the first is, if you ever come across a client that only has a very finite amount that they can put into a deal by way of deposit, so they have to achieve a certain loan to value to make the deal work, we can often be that lender to help. Because we don't stress test and we only need 100% cover at a pay rate, it often means that we can lend comparatively a lot more than other lenders. The second point down is foreign nationals and expats. So we have no criteria on where people can be from or where they live. We will lend to anybody. Adverse credit, including significantly impaired credit, so bankruptcies and IVAs in the recent past can sometimes be acceptable. First-time buyers and first-time landlords, they don't have to have any experience in the UK property market. They don't even have to own their main residence, and we can still find the solution. And also offshore companies and trusts. On the right-hand side, property. So the first is the point that I mentioned before, low yielding property. If you don't think that you're going to be able to achieve a good size lend with another lender because of their rental cover requirement, think of us, because we don't stress test and we only need 100% cover at our pay rates. Semi-commercial, so up to 30% of the property's value can be commercial. So shops with flats above, pubs with flats above, they're fine. Multi-unit freehold blocks, we can go up to 16 units. So a block of flats with 16 apartments, we could lend on a buy-to-let basis. Small and large HMOs, we go up to 18 rooms, so it can be a fairly significantly, the HMO can be of a significant size. Residential above commercial, that's quite a big one that other lenders don't like, and it's fine with us. Ex-council is also fine. Short leases is another one that's not on there. Planning irregularities is another one we see quite a lot of. The idea is that if you have a non-mainstream case, something that you can't get away with, a cheaper lender, they're the types of cases that we want to see and that we can help you with. I'm just going to go through 3 case studies now, just to try and outline how our product lines up against other products in the market. These are all real case studies, and the rates that you'll see from other lenders, although we've taken their name out, they are real products in the market. So here we've got a borrower buying a 3-bedroom house in North London. The value of the house is 900,000 and the rental income is 25,200 per annum. The borrower is fairly clean, so clean credit, UK resident, and they're a higher rate taxpayer. So these are 3 options that the borrower would have access to. So lender 1 is offering a 4.34% per annum rate. This next line is the next one that's important. They stress test at 125 or 155%. Lender 2 offers a 4.09% rate, but they stress test at 125 or 140%. If we put this on our cheapest product, which has a 4.99% rate with 1% deferred, giving a 3.99% pay rate, remember that we don't stress test. So the bottom line here is the really crucial one. How much can we lend and how much can these other 2 lenders lend? Lender 1, the maximum loan to value that they can offer is 51 or 42% loan to value. Lender 2, 54 or 49% loan to value. And Octane, we'd be at 70%. And that shows you just how significant not stress testing can be in terms of delivering a significant net loan. So this borrower is fairly clean. They could have gone to lots of different lenders, but if they only have a certain amount to put into the deal, and you need to find a lender to just, to deliver a good size lend, not stress testing allows us to do that. Case study 2, this is slightly more complicated in that the borrower is not straightforward. So here we've got a foreign national with 1 other UK property. The purchase price of the flat in London is 875,000. The rental income is 29,800. And these are the options that the broker that we spoke to attained. Lender 1 has a rate of 4.34%, but they need 140% rental cover. Lender 2 has a 5.29% rate, but they need 125% rental cover. And if we fit this onto our wave 2, so it shows you that if a foreign national can have access to our second cheapest rate, we still can cater for difficult borrowers down the cheaper end of the scale. Our rate would be 5.99% with 1% deferred, giving a pay rate of 4.99%. And as you know, we don't stress test. We only need 100% cover of 4.99. Crucially, that bottom line is the important one. Lender 1 can offer 55% loan to value. Lender 2 can offer 52%. And Octane, we would be at 68% loan to value. Again, just through not stress testing. Finally, this is a slightly more complicated deal. And I wanted to make clear at this point, the previous 2 case studies were both London properties. And look, we do lots in London. But we really have a genuine appetite to lend right across the UK. Right across mainland England and Wales. So we do lots of regional business as well. This is a good example, a 5-bed HMO in Liverpool, valued at 250,000, rental income at 32,500. So here, the rental cover requirement is not a problem. You know, you could take it to lots of lenders. The problem with this case is that the borrower had adverse credit, 2 CCJs in 2018, 2 missed unsecured loan payments, which made it more difficult for the broker to find another option. I haven't done a comparison here, but I'll just show you where we'd be. 70% loan to value, that's our maximum at the moment. Because of the adverse credit, it wouldn't fit on waves 1, 2, or 3, so it would be on wave 4, which has a 2 or a 3-year term. The rate is 6.99% with 2% deferred, giving a pay rate of 4.99%. No stress testing, and a 3% ERC unless the loan is redeemed in the final 3 months of the term. So before I go on to process, does anyone have any questions on any of those case studies? There's a few people typing.
Okay, so I've come back on now, Josh. Hopefully you can hear me. Yeah, there are a couple of Rakesh is typing again. His keyboard's very good use today. So would Octane lend to a foreign national that had no existing property in the UK? What would be required?
Yes, in answer to the question, yes, we definitely would. So I'm actually going to skip back here, if you don't mind, to the rate scale. This will all be in your product guide. So we actually lend to foreign nationals throughout all of the different products. But in order to fit down the cheaper end of the spectrum, you have to have existing UK property. So for example, in wave 2, you have to have 2 other UK properties. For wave 3, you have to have 1 other UK property. But if you have no other, if this is your first UK property purchase, we can still cater for you, but we would put you on wave 4. So the rate would be 6.99% with 2% deferred, giving a pay rate of 4.99%. In answer to your question about what we would need, we just need to understand where the deposit is coming from and the source of wealth. They're the 2 key questions that we need answering.
Okay, Arnold's typing a question, I believe, but I'll ask one of the ones the pre-qualified ones. Can you lend on new build apartment blocks?
Sorry, Tony, the line's really bad. I can't hear you at all.
Can you lend on new build apartment blocks? No. Can you hear me now, Josh? I did say these are out of our the technology side of it is out of our hands. Sometimes we're very much reliant on the internet connections between computers. So can you hear me now, Josh? I
can hear you, but it's coming in and out. But maybe it might be worth, I don't know, just maybe typing the questions. I don't know whether that's doable.
This question hasn't arrived yet, so bear me 1 second. I'll try and type this. I'll read it as I type it, just in case. So, can you lend on new apartment blocks? Excuse my typing, everyone. It's not the quickest. There you go.
Can you lend on new apartment blocks? Yes. So yeah, new builds are no problem to us. So whether an individual flat within a block, that's fine. Or indeed, if it even were a new build block. So remember, we can lend on multi-unit freehold blocks up to 12 units. So either is fine.
This one as well.
A few more people typing.
Okay. Will you consider a higher percentage of the? I know this is for semi-commercial properties, which you haven't really covered today. Will you consider a higher percentage of the commercial element above 25%?
Yes, we will. Actually, we go up to 30%. So it's a bit of a funny one, and we often need the valuer to comment on the commercial to resi value split, which is difficult when the property can often be one single asset. But we can go up to 30%. So somewhere within that rate scale, waves 4 and 5, I believe, up to 30% of the property value can be commercial.
Okay. Kalpana, if you hear me, Josh, Kalpana is just typing something. Arnold's question didn't come through, unfortunately. So maybe you answered it. So Cap, I'll just type in now. Hopefully, will appear. There you go. For those of you who might not be able to see it, would you lend for foreign national and property in the UK?
Well, obviously, look, we lend to foreign nationals without any UK property. So whether or not, that's not an issue. Whether we'd lend. I think in the event that we were lending to an individual who had a property in her husband's name, we could probably put them on a cheaper rate because of the fact that there's another UK property within the family. So yeah, I suspect we'd be able to fit that on a cheaper rate. Okay, Josh, that's all the questions asked. There's nothing else being typed. So thank you. Hopefully you can hear me. Thank you very much. Brilliant as always. I say everyone gets marked hopefully by the delegates at the end. Josh was the winner of our first one. So I was the first time I was actually able to tell someone's boss that they won best presenter. Doesn't look like you can hear a word I'm saying. So Josh, thank you. I'm going to wave goodbye. Okay, thanks, Tony. Cheers. And now move on to our final presentations. And I'm going to, first of all, introduce Charlie Gregory, who is a bit older than that photograph looks, by the way. When I saw that photograph for the first time, I thought to myself, I've got socks that look older than you, Charlie. But lovely guy. We've only recently met Charlie because I think he was appointed our BDM just as lockdown hit. So we've not actually met him face to face as yet, but we've met him a few times on Zoom calls and these type of calls. So delegates, you should have this lending guide in your hand. There he is with some Liverpool shirt in front, behind him by the look of things. You just need to take a grab of this. So a little bit here from Charlie. I always read these out, by the way. Some of you are wondering why I read these out. It's because some of the delegates aren't actually able to see the screen, so they may just be listening. So Charlie's a BDM at Market Financial Solutions, focused on providing brokers and their clients with fast, bespoke bridging loans. His background started with him in an estate agency, but more recently worked for a specialist buy-to-let mortgage lender for 2 years, working closely with experienced employees. My screen just went off, by the way. Charlie, did you just change screens for me when I was reading that? No. Okay, someone did. Right, okay. Charlie's already well established with brokers, enabled him to hit the ground running, although most of his MFS life has been spent in lockdown. He cannot wait to get out and meet everyone properly. We're looking forward, obviously, to meeting him. And here's his interesting fact. He was born in Paris, then spent 8 years in Japan, but he can't speak a word of Japanese, and his favourite food is fish and chips, but he will be doing his presentation today in French, no doubt. So, Charlie, over to you. I'll just put your slide on. We're also joined by one of his colleagues, Richard, by the way, who's going to answer any really technical questions any of you have. So feel free to try and think of the most difficult question you could ever ask anybody. And hopefully Richard's going to be able to answer it. So I'm just going to put presentation on now. Charlie, I'll see you in about 20 minutes.
Thank you, Tony.
All yours.
Perfect. Hi guys, yeah, thanks for that, and thanks for tuning in today to hear me speak. As Tony mentioned, I'm a BDM for MFS and I cover the South-Southeast region. Today I'm just going to talk a little bit about what bridging is, and then also go over a couple of bits of criteria and scenarios that MFS could potentially help with. So what is a bridging loan? Quite simply, bridging loans are an alternative form of finance that are designed to help people bridge a funding gap. So immediate capital, you'll hear people say it all the time, but for us, a major selling point for bridging is that you get the funds very quickly. So you get immediate capital secured against an asset. Now that can be a residential property, a main residence, or a buy-to-let. It could be a semi-commercial property or a commercial, with flexible payment terms. So the three different payment terms that the clients can consider is rolled up interest. So if they've got a 12-month term, the client's not paying back anything until the end of the term, the 12 months, and then they're paying back the full gross loan, or they can service the loan. What that basically means is they're just paying back the interest monthly. So on month 1 to 12, they are paying the interest. The benefit of that is just that they get a higher net borrowing at the start. Obviously, the disadvantage is just that they have to commit themselves monthly to those costs. You can also do a part retained, part serviced loan where they have a bit of both. So why using a bridging loan? So as I said, the main benefit to using a bridging loan is the speed in which the funds can be deployed. So we've got here buying while selling another property. In the unfortunate scenario where your clients unfortunately had a chain that's broken, they've committed themselves with a deposit for their onward purchase, and they haven't got time to find a new buyer for their sale. A bridging loan can help buy their onward purchase quickly, saving the transaction, making sure they don't lose their deposit, which is a lot of money, and also making sure they get their dream property. That also just gives them a bit of time then, whether that's 12 or 18 months, to sell their main residence to pay off the charge. Adding a new property to an existing portfolio. So that can be an experienced portfolio landlord looking to add new properties to their list. Or it can also mean, for example, a first-time buyer. So lots of long-term lenders aren't keen to lend. Long-term lenders aren't keen lending to first-time buyers. So what a bridging loan can effectively do for your client is, or shall I say, if you do find a lender that's willing to lend to them, it could be a much, much higher rate. In the long run, it's going to be a lot more expensive. So what a bridging loan can do for your first-time buyer is acquire the property for them on a 12 to 18-month term. And at the end of the term, they're effectively outside of that first-time buyer bracket, which opens the market up to more reasonable and more affordable rates with high street lenders. Renovation of a property for sale. So again, it gives you flexibility with a bridging loan. If someone wants to buy a rundown property, do a bit of work to it and then sell it at a higher level. Bridging loans, there's no ERCs with us at MFS, so they don't have to pay anything if they do exit the bridge early. And it just gives them the flexibility of doing a lot of work to a property that long-term lenders don't like you doing. Auction purchasing. So auction purchasing is a good one. It's something we come across quite a lot. A lot of the time with auction purchases, there are tight deadlines that have to be met, and long-term lenders, with all the underwriting they have to do and all the legal searches that they have to do, they just can't complete in time. So a bridging loan can help meet those tight deadlines because it is a lot quicker. It also, similar to the last point I made with renovations, auction purchases, a lot of the time there's the property's at auction because it's run down, it's not lettable, or it needs something doing to it. So a bridging loan can help fund the acquisition and then the works that need being done to the property. Commercial acquisitions. So that can be any type of commercial property. Again, some long-term lenders aren't keen on restaurants, takeaway outlets, something like that. But bridging loans absolutely fine. With us, you can acquire the commercial asset. So there's quite a bit of information on this page, so I won't go over all of it, but I'll just pick up on a couple of bits. So at the top left there, we've got residential investments. So it can help acquire new builds. We haven't got any maximum number of stories, so we can do high-rise or big developments. Ex-local authority properties we can help acquire. Buying from receiver. So that's a really good one as well, because I know, again, lots of long-term lenders aren't keen where there's a scenario where you're buying from a receiver. So it can just help acquire the property from the receivership and then look to put it onto long-term finance at the end of the term. Next to that, we've got buy-to-let. So first-time landlords, something that I mentioned just a minute ago, refinancing portfolios. Again, there's a common trend at the moment that portfolio landlords are moving properties from their personal name to limited company name. I think that's for taxation reasons. But again, a bridging loan can help do that very quickly. Some lenders that offer long-term finance aren't keen on that scenario. And once they have transferred them from personal name to limited company name, they can look to just do a standard remortgage, because that is actually classed as a purchase. We got leases that are under 40 years. So again, with quite a few long-term lenders, they might have a minimum term of 70 years, 75 years, something like that, that the property must have on their lease. So they're not going to be able to assist. Bridging loan can help acquire the property and then go through the lease extension to get it into a mortgageable condition and scenario. At the bottom there, we've got refurbishments. So refurbishments is effectively renovations, extensions. If someone wants to get immediate capital to put an extra bedroom on a property, they can do that. Conversions next to that. So we've got multiple properties to a single. So again, a common trend is to get a house converted to 4 flats because you're optimizing your rental yields. You're going to get a lot more per property. A bridge loan can help support that, and then look to put that onto a long-term finance after they've done the conversion with a long-term lender. Or it can be a single property, or sorry, it can be multiple properties to single, or it can be single to multiple, whichever way they want to do it. At the top right there, we've got semi-commercial properties. So I mentioned that briefly on an earlier slide, but again, we're okay with the commercial aspects that some long-term lenders aren't keen on. That can be effectively a flat with a bookshop below it, or it can be a takeaway shop below it. It's not a problem with us. Commercial lending, so that can be office spaces, warehouse, light industrial units. Any commercial aspect, we are more than happy to take a look at. So auctions at the bottom right there. Again, I mentioned that earlier, but with auction purchasing, the main benefit with a bridging loan is just the speed in which you can acquire a property, and also the fact that you can do a lot of work to the property once you've bought it, because a lot of the time it's not in a mortgageable condition, and that's why it is at auction. To the right of auctions there, we've got overseas. So we're fine lending to expats and foreign nationals. A really nice thing with us at MFS as well is that foreign nationals don't have to return to the UK to sign documents. I've got a case study that I'll talk to you about in a minute, which goes into a little bit more detail on one of that. Offshore companies as well. So however complex an offshore company or trust setup is, we can take a look at it and hopefully get a deal done. So how does it work? Forgive me if you guys already know how a bridging loan works, but there's effectively a first charge or a second charge. So first charge is where a loan is first, or only borrowing against secured against your property. So an example of that is a mortgage. If your property is unencumbered or you're buying it on a mortgage, that's the only charge on it. Therefore, it's a first charge. It's also second charges. So this is where there's already a loan or a mortgage listed against the property, and you're not looking to redeem that charge. You're just adding an extra charge onto it. For example, if a property was repossessed and sold to pay off an outstanding finance, the first charge loan would have to be repaid before a second charge loan could be paid back, because it was the first charge that was registered against the property. So the process, 6 nice and easy steps, which mean we are able to get funds out very quickly. Step 1, the loan inquiry is received. Step 2, indicative terms, subject to credit approval and receipt of information. So an indicative term just gives you an idea on what rate we'd be offering and what the total costs are. Step 3 is where the decision in principle is issued. That's effectively where credit have looked at it and have signed the case off. MFS as a lender, we do underwrite quite a bit of information at the front end of the case, but that's only because it's the worst thing to do if you don't look at some of the information at the start. You go through valuations, you go through legals, and at the back end of the case, you decline something on an underwriting basis, which you could have got checked out at the start. So we found that's beneficial and a lot more, and it's a lot quicker to get a decision if we're looking at stuff at the start. Step 4, valuations instructed. So if the client's happy with the decision in principle that's issued, we'll go ahead and instruct the valuation, and subject to valuation coming back okay, we'll also issue legal works as well with lawyers. So step 6 is the drawdown of the loan. So as I say, 6 nice and easy steps, which mean that you can get the funds very, very quickly. So what should you consider? The exit plan. So this is a big thing for us. It goes back to responsible lending. The borrowers will need to have an exit strategy in place to show how they're going to pay off the loan. It is very important because as a lender, We don't want the client to be in a position where they default and we have to repossess a property. As a broker, of course, you don't want that. And definitely as a client, they don't want it either. So we do look at the exit plan quite closely and make sure it's a liable option. And we may well not be able to look at the case if the exit plan just doesn't look like it's going to be achievable. Management of the loan. So borrowers just need to ensure they're prepared for any unforeseen costs, especially those that could arise during refurbishment projects. If someone's looking to buy from auction and refurb a property, if they are only budgeting enough for the refurbishment, what happens if there's some dry rot or there's an unforeseen circumstance, which means they're going to have to fork out a little bit more money? We just say make sure that they've got that contingency cash for those unforeseen circumstances. So choosing the correct lender, again, it's quite an important one, and there are hundreds of lenders in the bridging market. So choosing the right one for the project can be difficult. All I can say is speak on behalf of MFS that myself as a BDM and also the underwriters, we do work very closely with you as brokers and your clients if need be, to make sure that we're offering them the best service and getting them to the end goal that they want. So why choose MFS? Obviously, I mentioned it quite a few times, but speed and service. We'll respond to every inquiry within 4 hours, no matter how complex the case might be. Because again, if it's a situation where there's time constraints with a purchase, or if there's a broken chain, we know that we need to act quickly to get these funds out. In-house funds as well as multiple funding lines means that we can make a quick decision on various criteria aspects. That's a really good one as well, and I think that's what makes bridging lenders a little bit different to long-term lenders, mortgage companies. It's not just a tick box exercise with us, because we have multiple different funding lines and our own in-house funds. If the asset's strong, if the exit route is liable, there is a case to be done. So a lot of the time, if it doesn't work with one funder, we can always consider looking at another one to get the case over the line. So we will end up 75% gross of the 180-day market value. That's again a really good selling point, and only recently we've been able to go back up to 75% after the pandemic. So 75% is a really good selling point for us. We're able to consider up to that level. Heavy adverse credit accepted. I mentioned in one of my previous slides, but buying from a receiver or CCJs, defaults, absolutely fine with us. We do just require them to be redeemed when the loan's completed. So if someone does want to raise money to pay off a CCJ, that's absolutely fine. Yes means yes. That effectively, I know lots of lenders will say that, but that effectively means yes does mean yes. It was the point I made earlier, where we look at a bit of information, where we underwrite a lot at the front end of the case, because if we say yes, we do really want to mean it. Subject obviously to valuation and legals going ahead and nothing catastrophic coming out from those. If we say yes, we will work hard to honour that. So here's a couple of case studies I just wanted to chat to you about. So the first one, a £500,000 loan value, client's in lockdown, and it was a first charge. So our client was stuck in lockdown in Italy, which obviously posed challenges when it came to completing their property purchase with an asset that was in the UK. So the lender they were using, they weren't able to meet these deadlines, and they were risking losing their deposit. So the circumstances, the client was locked down overseas, a deadline was imposed on completion of the purchase, the long-term lender just couldn't complete in time. The MFS solution, the solicitor allowed legals to be completed via Skype. These documents were then couriered to our solicitors. Valuation was completed whilst taking into account all the social distancing guidelines, and we delivered those funds in less than a week to meet the imposed deadline. So it just meant that the client was able to gain that asset without losing money on their deposit. Next case study. So this was a commercial property, £1.2 million loan value, multiple properties on a second charge basis. So our client had a valuation come in lower than expected, and I can definitely say the majority of you guys watching now will agree that you're probably going to have, you've had at some point issues with valuers. It can be a terrible situation to be in, but obviously we need to produce a solution. So we were able, circumstances, there was a low valuation of a commercial property, needed to restructure the finance somehow, not able to pay off the competitive first charge loan that was already on the property, needed to move quickly. So the solution was we used other properties from the client's portfolio to bolster the purchase. This allowed the sale to complete as well as the finance restructure. We delivered the funds within 1 week to meet the client's deadline. So again, it's just going back to the fact that it's very quick and we're meeting deadlines. So there's quite a bit of information that we have on the industry, because obviously times are changing and things are being updated rapidly. You can look at reports, blogs, case studies, they're all on our website, or you can go over to LinkedIn as well and follow us on there, because we're constantly posting stuff. And yeah, any questions at all?
Okay, thanks, Charlie. We've got one from Rakesh again. Would MFS lend on a second charge property development above commercial? The client has planning permission to build 8 flats above commercial. What is the estimated rate on this, if yes? You said to no RE.
Richard, I think you're muted.
Yeah, Richard, you're muted. So is there an exit fee? I think mentioned that there's no exit fee on that. But
yeah, no exit fee, no. But I think Richard will be able to help with the rate and the answer on that one.
So it's definitely something we would consider. We'd like to know. I need to really know a bit more information about how much the property's worth, how much the existing first charge lender is going to remain on there before we can decide on the rate. I mean, second charge rates on a semi-commercial probably looking around starting at 1%, going up to 1.2 depending on the LTV.
Okay, hopefully Rakesh, that answers your question. I've got a few more that some pre-prepared questions as always. Which nationalities do you lend to?
So we can pretty much lend to any nationality. One thing we can't do is lend to someone who resides in a sanctioned country. So Iran, Syria, countries that have got economic sanctions. If they're residing there, we can't lend. If they're a Syrian national residing in the UK, we won't have an issue there. But if they're residing in Syria, then there's an issue. I think Charlie touched on it earlier. We don't require, if they're residing abroad, we don't require them to come back to the UK to sign documents, and we also don't require them to have a UK bank account, which I know sometimes some lenders actually do require them to have a UK bank account, but we don't. Okay.
Can you lend on a derelict building?
So we can't lend on a derelict building alone. So if it's just they just want to lend on this derelict property, use only the derelict property as security, it's not going to be one for us, but we may be able to consider it alongside other assets. I mean, we completed one last year where it was a derelict building. We used the value of the derelict building, had planning for residents to develop it, and that's what the borrowers were using the money for. But we also had 2 additional buy-to-let assets that we were taking as security as well. So we can consider it if we are taking other assets.
Okay. Final question, make sure there's nothing else from the delegates. What do you ask for in terms of fees? I know it might have already been covered, but just reiterate it, because that's quite an important one for many brokers.
So in terms of upfront fees, the borrower needs to pay their own valuation, which I think is standard across the board. We also ask for a small commitment fee, which is fully refundable on completion. We're happy to even if the case doesn't get to legal stage, we're happy to take a view and refund the commitment fee back. I mean, the commitment fee is going to range starting at 495, dependent on the loan side. So if it's like a £2 million loan, for example, it might well be like 1,495, but it is fully refundable on completion. I'm happy to even refund the commitment fee back as long as we don't get to the legal stage.
Okay. I think that's pretty much all I've got, because the other question I've got has already been answered, so I'm not going to ask it again. So that was great, guys. Especially impressive as your CEO was watching you as well. So I don't know if you was aware of that, but Parish High, hopefully they both they both did well. I thought they did absolutely brilliant. So, Charlie, Richard, thank you very much indeed.
Thanks, Tony. Thanks,
Charlie,
guys.
that shirt on the wall immediately, please. That Liverpool shirt. We don't want to be seeing that in shop. That's not on the
Thank you.
It's a great site.
But, yeah, as a West Ham fan, lifelong West Ham fan, I'll never have a shirt up on my wall. I can assure you. So, thanks, guys. Very impressive.
Thanks, Tony.
Just so everyone's aware, we have packager status with MFS. So, of course, you can go direct to MFS, but if you come through us, you get our expertise, plus also access to our sourcing system that we have, which is fairly unique, and also our relationship with MFS as well. So that's what we're here for. But great lender, and one of the very few lenders in the bridging market that I could probably say hand on heart knows what they're doing, which is quite important, because you're speaking to people who've actually got some experience, and they haven't got stupid structures in place where you can only deal with one person, even if they go on holiday, like one lender I can think of. So great lender to deal with, and yeah, they've been lending through lockdown and done a great job. Guys, thank you very much. Really appreciate it.
Thanks, Tony.